Awesome. Okay, this is probably one of the ones I've been looking forward to the most. This is Texas Instruments. I remember I kind of first got into Texas Instruments a while ago, but I think I want to talk about the stock as a whole and the company in general. A lot, like way before I ever even heard about it. And it all kind of comes down to the dot-com bubble. Now, a lot of people, they start getting into investing, and maybe they've heard of the dot-com bubble, or maybe they've seen a couple of things about it. Maybe they don't understand really how massive it was. Maybe they sort of have seen the NASDAQ, and they know that sort of the NASDAQ follows a chart very similar to this. In the 90s, stock crazy amount of growth, and then there was this big crash afterwards. And then the same thing happened in 2008, and then a big crash afterwards. And now, the market's just going straight up, right? You can kind of see the same thing here with, Texas Instruments. What's interesting is this level right here. This was a low for almost a decade. This peak became a market peak, and the reason why is very simple. Is because the market was crazy overbought, and you had stocks that were $10 going to $100 in the span of a year. And so when that starts to happen, you kind of know that something's going on. A pretty general rule of thumb that works really well. This is something that I sort of discovered when cryptocurrency markets were just going straight up before the recent crash. Well, I mean, it's not that recent, but there's, it's a volatile. Anyway, but before everything died and crypto was exploding, there was this really interesting trend that started happening right before, this was 20K, right before the top. And when it was kind of right around here when everyone was making the bulk of their money and trying to get out and just keep profits and follow those rules we set up last module about taking 10% or taking 5% or maybe 15% and then just taking that out of the market so you have our initial investment back. A lot of people were kind of in that phase of their investments, and then it was sort of getting really close to the top of the bubble. Now obviously it's kind of difficult to predict the exact top of the bubble, but if you think about it really hard, you could probably do it. And for me, there was this one thing that happened that totally shifted everything and made me realize holy crap, oh my gosh, this is bubble. It's about to get over. This is really bad. And that one thing is actually pretty basic. What happens is at the peak of really big financial bubble, you start to have something really interesting happen. Most people don't really care about investing, which sucks because investing is freaking awesome. But just in general, the people who are super passionate about investing and doing everything they can, spending a couple of hours a day managing their investments and having absolutely killer returns, it's not 90% plus of the population by any means whatsoever. I mean, I'd say a small, it's a growing segment, and it's a pretty freaking dope segment, and there's a lot of money to be made in that segment, but it's not a majority, right? And so usually you have a couple of people and they're oh my gosh, we just made 40% trading this stock. Oh my gosh, we just made 60% trading this stock. Oh my gosh, we just quadrupled our money in a month on these options. It's been amazing. Holy crap, it's awesome. And those are the kind of people I like to hang out with because they're freaking dope and they're going to be rich one day if they're not already extraordinarily wealthy. But what's interesting is you have those people working, doing absolutely phenomenal with their investments, but no one really, because there's not a lot of what kind of comes up when you have a bubble is media, right? There's not a lot of media attention. It's not the popular thing to do is to go and trade stocks or other kinds of assets. And so because of that, not a lot of people actually care. And so what happens in practice, here in a bubble, is really interesting. You start to get this media attention. All of a sudden, there's more new people that start trading into these financial markets. And I remember this happened when Bitcoin was going up super high right before it crashed. There was a ridiculously gigantic amount of people that bought their first investment ever that I knew and that I connected with and that later on afterwards actually taught. There were tons of people. This was the first thing they'd ever invested in their whole life. The reason why is because of something you should never make an investment based off of, which is media. It's in the news and everyone's oh my gosh, everybody's getting rich with tech stocks, everybody's getting rich with cryptocurrencies, whatever it is, whatever the bubble is. And what happens, you get a ton of new people coming in. That's really when this could be it right here, this could be over. And for me, when it really hit with the cryptocurrency bubble, so obviously I wasn't alive in 2000, or I was maybe 1 year old in 2001 or something like that. Everything was coming to a crash. I walked into history class one day, and my history teacher, I remember we had this section on financial markets, and we had like this is insane. There was one day of class for the entire year where we talked about stock markets, which is ridiculous because it's literally the coolest thing on the planet, and it's probably worth more than almost anything else you could learn in any kind of education system. And we spent one day out of an entire year talking about stock markets. He literally didn't know. He knew so little about it. He like had me teach the class that day, and went through his PowerPoint for him, and then like taught all this stuff for him. And so that, I just want you to understand like where our base is here for this guy who just knows like almost nothing about financial markets. And then cryptocurrency started exploding. And then one day I walk into class and he's pulling up his Coinbase account. And I mean, this is when like stuff was super high. This was the peak, or if not like a couple of days, a couple of weeks away from the peak. Stuff was crazy high. And this guy who had never ever in his whole life like even cared about financial markets, and I don't know why, I think he had like this state provided teacher retirement plan or something. Oh gosh, there's a special kind they get with like tax benefits. It's in the book and everything. I remember he's got like this, I think it's a 503, 504, 503B or something. He's got this account. He's like never even touched those investments in his life. And now he's getting into like speculative, crazy, super cool, super risky investments. Why? Not because of the returns, because the returns are already here. People are already absolutely crushing the financial markets. The only difference is you have media that publicizes, right? You have a publicist that publicizes these returns. It publicizes all the money that's here. And so everyone sees like all this newfound money. Even though it's the exact same money that was here, all of a sudden it's way easier because instead of it being in an individual stock, all of a sudden it's in like an overarching index. It's in like a really, like the NASDAQ, it almost looks exactly like this. And the reason why is because the entire market was crushing it. And so instead of having to like actually do things and like look at individual stocks and put in like 45 minutes of effort to find stuff like Texas Instruments, you could just like buy the market and you would like double your money. And so like when that happens, that's kind of when you know that like you're about to have some kind of pretty big crash or something like that. And so that's one of the really big things to kind of remember here with Texas Instruments. That one is going to be having like a bigger spike than anything else just because it's more tech stock. And it's also going to have greater overarching long-term growth because it just does better. I don't know what else to tell you. But what's interesting is, okay, so now that we have that out of the way, now you understand sort of how the markets work, and we've sort of gone through this .com bubble, which is important because like this level, this price level right here at, I'd say give or take not 2,000. So in the vast majority of situations, when the individual stocks do really well, it can often be just because of the market doing really well. And so this is what I like to call, a market play, right? And I use this word a lot now, especially with investments that I'm holding, without necessarily having a technical pattern backing it up. If I don't have like any indicators or anything like that, it's just like, I don't know, it kind of looks like a good long-term investment or a couple of year investment before the markets reverse or whatever. Then I'll call that a market play, and I'll play it as if it's the market, but I'll play it sort of on steroids, right? We had a comparison here with the S&P, the NASDAQ, and you can see that this stock is very greatly outperformed those indices, and the reason why is this company has made more than the average in those indices, or it has had higher growth than the average in those indices. And so, you know, if you've got a basket of a couple hundred stocks, and you can kind of individually pick out, like, this is a really good one, and this is a really good one, and all of the other ones suck and they're really bad, and these ones probably have about the same volatility and twice the upside, then it totally makes sense to just buy those stocks if you can pick those stocks. You can figure out which ones those are, which isn't like the easiest thing to do. But if you know like one of these companies is better than the rest, then it makes perfect sense to just invest in that and see, like, if you're right, then maybe you should keep doing that, and if you're not, then maybe you should invest in indices, at least for longer term stuff, or swing trades without patterns, right? So this one didn't have that much of a pattern. This is one of my first investments. We'll get to that in just a moment, but I just want to make sure that you understand that this price level right here at $75, which was the previous high, like even though this previous high was in the year 2000, and it was like literally decades ago, that's still going to be a really big psychological price level. And what happens with this psychological price level is really, really interesting. It doesn't matter if this is like 20 years in the future, doesn't matter if it's 2 decades in the future, or 2 centuries in the future. Like, if the stock continues to be around, where it's consolidated right here, and it sticks around this price level at like 75, 80 bucks, like anytime it starts to approach this price level, it's gonna have a difficult time breaking. Similarly, as it comes back down, if it approaches this price level again, which I don't really know if it will or not, but it definitely could, then it's gonna have some consolidation around this price level because it's a really, really, really strong support resistance level, right? And it's just a horizontal line, but this horizontal line is a very, very well established because anytime you have massive peaks or massive bubbles, those are going to be huge levels where a lot of new investors, like you said, a lot of new investors come in at the top. Recently, I think we talked hopefully about Tesla and how they had exploded. And after they exploded, what happened was there were like tens of thousands of new investors, and they bought their first stock ever. And the first stock they ever bought was like way at the top. And then they bought it like the day that it peaked. And then they lost a bunch of money. The reason why is because they didn't really know what they were doing and they were following the masses, which is obviously not what you're gonna do. But because they bought in like super, super high at the top, most people, they have a difficult time, and this is a big challenge that you definitely need to overcome. And this is why you always have a stop loss. Most people though, they aren't as smart as you and they don't have a stop loss. So they get to some really big level, and instead of stopping out and just getting out of position, they make the mistake of holding through it and then continuing to have the value of their position go down. And this leads to something called like a break-even fallacy. And it's a very, very subtle but easy to understand concept. And it's one that I've seen over and over and over again as, like I said, a lot of people I know first got into cryptocurrencies when it was like at its peak, when it was this massive bubble, and then they bought a bunch, and now they're like, they didn't set a stop loss. Like, you have to have a stop loss. They didn't have a stop loss on a market play. And long story short, they buy, metaphorically here with cryptocurrencies, and if you pull up the chart on Bitcoin, it's this huge spike, and then this massive crash afterwards, and since then it's been doing pretty freaking well. Less chance that it might go up to a new high later on in time. There's this really big fallacy, you can't lose money. And that is so dumb. And this dumb idea that like the stocks will only go up because like historically, yes, they will only go up. And historically, yes, if you just keep holding it, in the next 20 years or so, like yes, it will historically and for all likelihood, for all intents and purposes, go up. But like I don't want to wait 20 years if I can make a trade like right now that's gonna give me the same, if not better, returns. And so that's kind of the subtle difference here. Is obviously you have that stop loss, but similarly you have the discipline to say, look, I'm going to take this loss, and I'm going to be okay with this loss because I know that it's better than taking a bigger loss. And that's a very tough distinction to make, but it's really important because once you make that distinction, it puts you in a really, really powerful position. Where instead of like being at the whim of the market, having to go up and down, up and down, up and down, all of a sudden you take control of your investments and you say, look, I'm in here, my target is whatever this price is based off of technical analysis, that's my target, and this is my stop loss. And as soon as you do that, all of a sudden your trades are in and your trades are out. And even if you're trading on a monthly chart like this, and you spend maybe an hour in an entire year managing those investments, in your mind that you're not just gonna do what most people do, which is hold until it bottoms out. And then what's even crazier, is most people sell at the very bottom because they're like, oh, it's so low, I better sell and get out. And it's just crazy. Most people, they'll buy super high, and they'll sell super low. And the reason why is you still know what they're doing. And so it's really, really critical that you actually understand what you're investing in. Okay, does that make sense? Is that cool? That's a really big lesson to learn as you're getting into financial markets. And it's one that applies not only to individual stocks, but also really, really major indices. So with that said, let's move on now to Texas Instruments. So just like some of you guys might have heard Texas Instruments, most of you guys likely have a calculator by them, which is pretty cool. I just think they were like this massive calculator company. And what's kind of interesting is, and it might be a little bit hard to see on this chart, but it's pretty noticeable. And I'll zoom in just a little bit to show you this. Because most people, they know Texas Instruments because of their calculators. And so you can kind of see around September every single year, from about September, August, which is about midway through the year. We'll start here maybe 2010. You kind of see from like the middle of the year to the end of the year, they go up. And same thing here, 2011, from the middle of the year to the end of the year, they go up. 2012, from the middle of the year to the end of the year, they go up. 2013, from the middle of the year to the end of the year, they go up. 2014, from the middle of the year to the end of the year, they go up. 2015, from the middle of the year to the end of the year, a little bit less sturdy, but from the middle of the year to the end of the year, they go up. 2016, from the middle of the year to the end of the year, they go up. 2017, from the middle of the year to the end of the year, they go up. 2018, from the middle of the year to the end of the year, so the 1 year where they went down. And then 2019, from the middle of the year to the end of the year, they go up. Now, obviously, this is a bull market, right? So a little bit biased, right? If I go back in time and I start at 2000 and 2000, maybe 1999, like you're gonna see a different trend, right? You're not gonna see, 1999 from the middle of the year to the end of the year, they like literally, I think they tripled. 2000 from the middle of the year to the end of the year, they went down. Why? Because there's a market crash. Like trends are phenomenal, and they will work very, 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 very well for you. But you cannot overpower something like a .com bubble. You cannot overpower something like a housing market crash. At least I don't think you can. 2008 from the middle of the year, to the end of the year, they go down. The reason they go down, why? It's very, very, very simple. Like you're not going to have an individual corporate trend overpower an entire market. So that's kind of one of the big things that you see here is this trend of like people buy their calculators when the school year starts around August, around September, around the middle of the year. And then, just by nature of like how people think about calculators, usually you don't buy them in the spring. At least I never have ever or seen anybody do that. And so usually like the first half of the years, they kind of go down a little bit just based on public perception because, like no one's really buying their calculators, right? And so that's kind of the trend that we see here, and it works really, really well. 2001, middle of the year to the end of the year, they go up. 2002, middle of the year, end of the year, they go down. And I think that's kind of fair because the whole market was going down. So you really need to understand not just the patterns, but also the overall market that you're in. 2003, 2004, from the middle of the year to the end of the year, they go up. 2004, 2005, from the middle of the year to the end of the year, they go up. 2005, 2006, from the middle of the year to the end of the year, they go up. 2006, 2007, from the middle of the year to the end of the year, they're kind of flat because it's 2007. Then 2007, 2008, it's relatively flat, maybe a little bit down. And then 2008, 2009 is again the crash economy. So like I would say maybe 85 to 90% of the time on a year-by-year basis for the past 2 decades, basically Texas Instruments from August to December, January, it goes up. And it usually goes up a pretty significant chunk. And if you kind of ignore recession years or years, again, the inverted yield curve happened in 2007, and then another one just happened in 2019, a while back, I guess. But anyway, so you can kind of tell like if there's an inverted yield curve in U.S. Treasuries, then that's going to sort of be the start of your crash. And if you guys maybe aren't as caught up on that, I have a whole video about the inverted yield. I have 2 videos about the inverted yield curve. You just go to my channel, look up inverted yield curve, look up inverted yield curve, John Luke or whatever on YouTube. But basically, like the U.S. government has these 2-year bonds, and they have these 20-year bonds. And you go to somebody and say, look, I'm going to give you $100 for 2 years, or I'm going to give you $100 for 20 years. Like you would expect, you would get paid more to lock up your money for 10 times the amount of time. Sometimes this is a 10-year instead of a 20-year, whatever. But basically, what happens in an inverted yield curve is you actually get paid more to lock up your money, to loan out your money for a shorter amount of time. And so the yield curve inverts because you've got sort of the short-term curve right here and the long-term curve right here. And then once you have that inversion, all of a sudden you're getting paid more money for less time versus like the 10-year, the 20-year. So that's kind of what happened before like literally every single major U.S. recession in the past 150 years or so, without fail. Like there was an inverted yield curve. And then I think maybe like one time it wasn't 100% accurate, but usually within about a year, I think it was like 12 times it's been a recession. Like within about a year, the market crashes. And usually from inversion to the start of the recession, you have about a 20-25% gain in the actual market in terms of like S&P growth. But like pretty much without fail, like it's about a year usually. And then after the inverted yield curve, that's sort of when you have the start of a recession. And so like that kind of sucks. But like if you know that's gonna happen, you can know that you should short instead of buy long and then you can make a bunch of money anyway. So it's not really that big of a deal. You just need to like know that it's happening. And if you want to get a lot deeper on that, just check out those inverted yield curve videos I made, and they will like show you exactly what to do. And I think I also have one that shows you sort of 6 strategies to profit from it, which is pretty dope. Because calls on these guys are like dirt cheap, and you can like double, triple. I mean, they're like that's a really good strategy. Like especially sort of when I was starting out, like back here, you could really like quadruple your money on these calls. Like it's pretty crazy. And you guys have heard this before. If not, well now you're gonna learn because it's freaking really interesting. Fixed instruments, they are huge and they're known for what? They're known for calculators. And they own, like, or they control, I would say, like 95% of the calculator market is Texas Instruments. You don't buy like any other kinds of calculators to go to school. Like most often, you're buying TI calculators, right? And so like they own a lion's share of the market, right? But what's interesting is all this money that comes from all these calculator sales, you look at their actual earnings report, you look at their actual balance sheet, they make, give or take, $1.5 billion per year in revenue. Less than 3% of that actually comes from calculator sales. And it's actually such a minute number for them that they categorize it under other on their report. Like they put it under other. It's not even its own thing. It's like categorized under other. And I read that, and I was like, what the heck? Everything I know about this stock is wrong. Like, why are they going up during the school year and then down after, at least the first half of the school year? I originally thought it was calculator sales because it's Texas Instruments. And most people, they think of Texas Instruments, they think of calculator sales. And this is where we start to get into a very, very crucial but subtle difference is going to emerge as you start to invest more and more and more and more and more. And the difference is one that you have to master. Because once you master this, you literally have the ability to create sky-high levels of growth in any investment by playing off of public consensus. And the strategy and the difference, it's very subtle, but it's very important, is public perception, this is what people think, right? This is what the media wants you to think. This is what Wall Street wants you to think. This is and people that are feeding you that information about like this is the best company ever, this is the worst company ever. Usually those people that have hundreds of millions of dollars invested in the stock and they want it to go up a bunch so that they can sell it to you for a huge profit and then tank it afterwards so that you lose a bunch of money and they make a bunch of money. And so that's, you got like public perception versus reality. So like most people, when they think about Texas Instruments, their public perception is like, oh, these guys, they make calculators, right? But in reality, like that's less than 3% of their actual income. And a vast majority of it comes from one thing. It comes from wholesale. I remember I first read this, I was like, what the heck are you talking about? Like I didn't even understand what this combination of words meant at first. So if you don't understand what this combination of words means, please do not worry about it. It does not matter. Semiconductor manufacturer. Wholesale semiconductor manufacturing. Say that 5 times fast. Because I couldn't do it. Basically what this means is they make like those silicone chips and they make like those little computer chips that are like the kind of the green things if you ever seen inside of a computer. Sometimes they're different color, but usually that's kind of what they are. They make these little chips and then they make like a bajillion of them and then they sell them to really, really big tech companies in bulk. So like a huge percent of the profit. You can kind of check out their annual report to see it for yourself. But most of their money comes from one thing, and that one thing is not calculators. That one thing is wholesale. I'm going to call it wholesale semiconductor manufacturing. And it's kind of crazy. So this is why it's important when you're looking at your reports, you're looking at companies, to ask yourself like, where is this money actually coming from? And so right here we have one of the recent reports, kind of older, but you can see like this is like the second page of the report, and they're emphasizing like these really big numbers on like growth and cash flow and the amount of money that they're giving out in dividends. And you can kind of see, I mean, they've paid a dividend like every year for like all of history. I mean, they've got like, it's a pretty great dividend. You kind of see as you start to get into early like reports, companies are going to emphasize what they want you to focus on. They're going to emphasize stuff like cash flow. They're going to emphasize the things they want you to focus on. But everything else is usually just going to be stuck in this Form 10K or otherwise kind of hidden away or ignored. The reason why is because they want you to focus on like the really big numbers. They're going to make them look phenomenal and make their stock go up a bunch. instead of, you know, focusing on what you want. So like sometimes what you can do is you can just push Control F. So they make a lot of stuff for really big companies, and you can kind of see like almost, I'd say about 95% of the revenue, give or take, I'd say, comes from about 20% of their sales. This is kind of this idea of the 80-20 principle. Like a bulk of their money comes from like super like wholesale big things, not like all the work they have to do to distribute like a bajillion calculators into every Walmart on the planet or on Amazon or whatever. And so that's sort of this separation you have between like what most people see as perception and what's actually going on, which in this case is a lot of wholesale production of like computer parts. And that's where like literally almost all the revenue comes from. And so it's really important to understand that, because when you get into the investment, like you want to actually know what affects the industry at a fundamental level. Even though like people are going to think Texas Instruments should go up just because of the school you're starting, you want to know in the back of your head, okay, cool, people are going to think that, I understand that. But you also want to know that like this actually has a different story. You want to know what the real story is, so that if someone really like sells like hundreds of billions of dollars of stock, you're going to be ready, you're going to be prepared, you're going to know why at a fundamental level that happened is because of what? Because of the details of the underlying company. So that's a huge, huge, huge lesson to learn from Texas Instruments right there. So with that said, we got in this at what, $85? So that's like over here, I'd say it's like right here. So you got in, and they went up a whole bunch, which is really, 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 really sweet. And this is where I made a very subtle mistake. And you might be able to catch it if you've been following along really, really closely. There's two things here, and the first one I've highlighted for you is this really big kind of upward resistance line based off of this peak and this green candle, red candle reversal, and then this peak, and then this peak, and then this, and then this peak. So basically like this, right? So like look backwards from this point, and you kind of have the setup I was looking at. So you got those peaks, and you've also kind of got like this line that comes from like this bottom, and this bottom, and this bottom, and this consolidation, and these bottoms right here. And this probably wasn't the best line ever, but I mean, you could also draw the line right here. I'm not saying my lines are perfect, but you know, it was a pretty decent representation of what's going on. I drew this in like half a second, so I guess I could have done better. I feel like, you know, if you wanted to do better, you could do a line like this, and it would actually connect with a lot more of these points. And that probably be a better line. But what's interesting is like, it doesn't actually matter. The core and the principle and the foundation of it is that basically what you're looking at here is an upward wedge, right? So an upward wedge with most long-term investments, most swing trades, you guys know this, you have an upward wedge, and then it falls out and goes down a whole bunch. And so that was the first thing I saw with this investment. More recently after I bought it, and it had gone up like 10, 20, 30%. And so I saw that, I was like, crap, it's gonna go down a bunch. And I totally missed something that was really, really, really critical. The first thing I missed was that it was like the middle of the year, and I mean, guys, Texas Instruments only goes up because the school year starts, and obviously everybody's going out to buy calculators, especially in hype markets. Like, you're gonna see the stock go up, and it's gonna follow that pattern. So I totally, first mistake I made, was I totally ignored the pattern that like 90 to 95% of the time, like Texas Instruments will go up from like I guess August, September to like the end of the year, January kind of time. I totally ignored that, which was stupid. And then the second thing I ignored is a little bit more subtle, but it's very, very, very powerful. And I think the reason I ignored it is because I was looking at the monthly chart, I couldn't see it as well, was because was this inverted head and shoulder setup. So right here, you've got this really big inverted head and shoulder setup right here going on. And you kind of got a bottom at like, I don't know, $80, and a high at like 120. And maybe a little more conservatively, I'd say like 95, $90 right about here. I say $95 to 120. Maybe a little more conservatively, we'll say like 92 to 112. So that's give or take $20. You add $20 to 112, you get about 132 as a target, which I think is pretty reasonable. And that's basically going to take this right here and then give you your target right up there at about 132. And that's a long position, right? That's an inverted head and shoulder setup, and then it goes up a whole bunch afterwards because that's kind of how inverted head and shoulder positions work. And so that was really what happened. And what I didn't understand here is something that's very, 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 very critical.